do that a little bit better? How can we help you realize that the money that we're already spending and the way that our economy is set up, it really can be from a better direction? So that's what we're going to be able to show you tonight with our Debt Free Life program. So let me first of all get the everything sharing up on here. That way you'll be able to see what I'm talking about here, and it's not just visual. Here we go. All right. So, like I said, debt-free life, it's been time tested. How can we help you get out of debt in, really 9 years or less, spending the same money that you're already spending? And that's, what we want to be able to show you by going through this. So, where I'm really passionate about this is that, like I said, the conversations have often come up. I'm going to have to work till I'm 6 feet under. I got the kids in college, or I've got the mortgage, and I just don't see retirement as even being in the cards. So I know the answer when I can point blank ask, are you 100% sure you're going to have a great retirement, or do you have doubts? And that's the point, is who really is 100% secure in that. And, with what we're going to show you tonight, I think you're going to feel a little bit better about there is another way. So, in that other way is really, what if I could show you how you could get out of debt in 9 years or less, including that mortgage, student loans, whatever the case, we can take a look at. But we're going to use a strategy that's going to help you spend money better than the way that you are today, but the same money you already are. So really, where this whole journey comes from is really looking at, throughout life, we've had all kinds of, it's been unique. It's been filled with, hey, we go to college, we try to earn credit by getting that first credit card, put the electric bill in our name. You know the game, where we all had to start somewhere to earn some credit. And then along that, we've had, triumphs, setbacks, having, get married, get the house, have the kids, have the student loans there, and what happens with the mortgage, the car payments. All these things are just part of life's journey, sorry. But it can really make you feel like every time you take a step forward that you're taking 2 steps back. So after all the major life events, we finally get to retirement, and guess what? We're still in debt. So, what I'm showing you right now is the reality that it's not just you and me that have debt. This is our nation's epidemic. If you look at the national debt statistics, we've got, the entire country is, upwards of $21 trillion in debt. And look at where the auto loans, 1.2 trillion, credit cards, 1.2 trillion, student loans, and onward with mortgages. I mean, that right there is over $13 trillion worth of our nation's debt. Debt is an epidemic. So where right now you're looking at our total debt balance, this is our nation. When you look at the housing debt, and then when you add non-housing debt, so you can see how a big part of this, the dark green, that's the housing, right? And debt being at its record high, and now even with where we're having to go through stimulus, through COVID, it's just it's not getting any better. So that's where we have to look at, how can we control what our debt balances are. So here's the average American household. And this might resonate with you as to how your spending is. Okay, so if the average American household has $250,000 in debt, and they're only able to usually put away about 3% into savings, right? So then when you look at a lot, where with the savings, that's really where that retirement's supposed to come from. So financial advisors will say, hey, put more into the savings. But when we're already having to pay so much towards, our 34 cents on every dollar into interest, 40 cents on every dollar into taxes, that's not even leaving enough to be able to save for even our general lifestyle. That's only 23% into lifestyle. So where's this extra money supposed to come from for us to put into the savings? So when you know that this is how we're doing it, and to know that, is there a way out? How can we make sure that the banks and the government, that they're not taking 74 cents out of every dollar that we're earning? So how can we fix that? So this is the other problem. It all does kind of link up to we work so hard for the families that we love, right? We want the quality of life, but we also want to be able to not have to work until the day we die. We want to be able to have, that American dream of that retirement, right? Of I want to travel. I want to be able to, walk my daughter down the aisle, the dreams and things that we have in retirement, and yet you start to feel that panic. Can I do it? And here's the reality is think back to how old you were when you started working, right? I was 15. So if you think to when you started working and all the way through to where we are, do you realize that the average person will have over $2 million pass through their hands by the time that they retire? Now, here's the problem. Only $60,000 is typically what is able to be saved. It doesn't really seem like that American dream or that wedding for my daughter isn't going to be stressful. So that's exactly why we want to be able to do this. And I want to show you all tonight with one of our clients, Renee and Anthony. I want to show you how we were able to help them. But I want to pause a minute because I want to make sure that you have the opportunity to say, okay, if what I've heard so far resonates with me, okay, do I have enough to be able to even afford the quality of life and put savings aside? Do I feel as though I'm going to have a good retirement? Do I feel as though I'm going to be forever in debt, right? Especially if you have student loans. So, as we go through this, I want you to visualize exactly what is your scenario. What is it you want to take away from this? Because trust me, this isn't just for you to meet Renee and Anthony. This is so you can be able to say, okay, what would it look like for me? How does this work for me? That's exactly why in the beginning, when I introduced that we have many certified agents to be able to help you, they're the ones that invited you here. I have some friends in here that you're realtors. How many times have you had a client that they can't qualify yet for the loan that they want to get because their debt to income ratio? Well, you can be the solution for them by simply introducing, hey, symmetry's got a way, and you just need to know what you don't know. So, as we go through this, and I'm thinking this is where more questions are going to come up in your mind and things that you want to make sure that we address. I want to make sure in the chat feature, everybody's in here on Zoom. And if you look, you have a chat. You can click on that, type in messages for the chat, and we're going to culminate and make sure as we go that I get them answered. And at the end, we are going to have Q&A. So I am going to ask if you could hold questions for now. Everyone in here is muted, but yes, you can unmute to be able to speak with us for open Q&A. So let's get to it. Let me show you how this program works. So then that way you might see exactly why is this worth my time? Well, what do I do next? And that's what we're going to answer for you tonight. So Renee and Anthony, they benefited from our debt-free life, and it all started with the fact that we were like, "Hey, we need you to fill out these worksheets. Let us do a financial analysis." And all this is, if you look, they filled in that, their age, their dates of birth, their income, their goals. And so if you look at this, that both of them they're in their 30s and they both want to retire by 65 and they have the average, monthly income and they have the kids there. So of course we all know children can rack up where they're not exactly the cheapest thing, but they're the biggest blessing. At the very bottom, look at the common concerns that they shared. They wanted to know, hey, these are the things that you're saying you might be able to answer some questions on. First of all, we want to be able to control our spending a little bit better and provide for those children, even our grandchildren, that we're going to have education. College is not cheap. That's up in front of us. But all the while, how do I eliminate the debt I have today so I feel as though I can look to the future? And that's where you look at how can I save for retirement? How do I create the wills and trusts that provide a legacy for my family and maximize the savings. So in that way, I don't know, when you want to go on a vacation, maybe you could. But it's kind of hard when you feel like there's always this mountain of debt. So when they marked, this is what their goals were. And then the response back, hey, Renee, Anthony, do you have any specific plans to currently so you can accomplish these goals? And they're like, no, not yet. So, that being said, we were able to look at one, where are their monthly contributions? This is pretty normal, right? Everybody tries to put a little money aside. So they were putting $25 a month, kind of that hidden fund. I'm not spending it. And we call that your emergency or emotional fund. The what if? What if I've got to replace the hot water heater, or is that my vacation savings? So they were putting aside $25 a month. So far they have 6,000 in that emergency fund. And then you look at the retirement, putting $300 a month towards retirement. You added 36,000 so far, and that's going in your traditional 401k. So with that, we also were able to take a look at their debts, right? And this is typical. Think of your own. Do you have a credit card? Does it have an interest rate? Whether it's 12%, 21%, 0%, I don't care. It's a credit card and it carries some sort of debt. Okay. So that being said, with this, they had a small little balance on one card at 460. They did have the medical dental bills, like I think of my daughter's Invisalign, like, hey, I got a small bit I still need to pay off there. They had 2420. Credit card number two with a little bit higher interest, owing 4200. Then they had some furniture, the car payment, and of course the mortgage. So if you look at this, they had the total debt, they had 180,198. And the other thing that's important to look at is the average interest rate here when you go down the line, 9.25% interest to be able to carry that kind of debt. And this is what's providing quality of life. Now, the 2177 a month is what they're spending total towards the debt. And that's going to be an important number when we come back to that in a little bit. Okay. So now take a look at this. Is that you had the 180,000 that I said that, look, that's the total debt, but you've got to take into account that you're also looking at the interest. When you go and you add that 9% average interest right on top of the debt, you no longer have the thought process of this is my debt, you have real debt. And so the total being 380,000, that's a big game changer. So that, of course, was a shock to Renee and Anthony because, they just, hey, I owe $180,000. So, and that's pretty common for most of us. So when we run our real debt for you, the client, we're able to take into effect what are the real debts, what are the actual interests. So that way, from what perceived debt, what is your real actual debt. So that way we can be able to help you over the long term. If you continue down the same path, this is how long? 30 years to pay this off, 30-year mortgage, right? So staying on this plan really didn't seem like it was an ideal pathway to get to retirement. So speaking of the interest rates, I want to make sure, do you know how they work, right? So let's take about the mortgage. Okay. So if you have a 5% interest rate, which nowadays, hey, interest rates are even lower, they're going great. A lot of people are refinancing right now. So regardless, I'm going to take a general 5% interest. So if you have 5% interest paying 1610 monthly on that $300,000 mortgage on a 30-year fixed term. Well, the reality is that let's look at what the actual amount that you lose on the mortgage itself. So a lot of people don't realize this. So why should I pay off the house? Should I pay the house off early? I've always heard it's a good write-off. Well, you tell me by the end of this particular slide, okay? That $300,000 mortgage I just talked about, 1610 a month. The very first year you take a look at that, you see 78% interest. 78% of that payment's actually going to interest in month one, okay? 10 years in, we're still paying 63% towards the interest. Not a whole lot going towards the principal, is it? Now we're in year 20, 42% of that 1610 a month going right on in to the interest. Do you know when you actually get to the 5%? Finally, in year 29, you're at 5.3% interest, and you luckily on the last payment you get 5%. So, are you really getting a 5% interest loan? If you're refinancing right now and you're grabbing up that 2.75, are you really getting 2.75? I could show you the numbers at whatever level it is. It's the concept that we are indebted for however long your mortgage term is. And yet, there's something we could do about that. So, the traditional the traditional way, if I were to say, um, someone's options to get out of debt and eliminate paying the interest, most people they would say, okay, I'm going to work harder, spend less, save more, hope for better interest rates to come along. There's always an option of snowballing debt. Pay off one debt at a time. Use the savings from that eliminated debt to be able to pay the next one. But that's going to take a long time. And see, at this strategy, do you realize, even with debt snowball, and I'm going to address this, that there's only a 1% success rate? See, a lot of us have heard, whether it's financial piece or strategies of segment, put your money when you're done spending on that, move it to the next envelope. Here's the problem is that it doesn't ever let you focus on increasing the success rate, cutting down the time spending on paying the debt by what you're going to be able to learn by leveraging life insurance. That's right. You're going to be able to learn how can you leverage life insurance and actually follow suit with IRS tax code to do it. So, if I told you that there is a better way, that if I could show you how to get out of debt in 9 years or less, including that mortgage, without spending any more than you're already spending, that's what I'm going to be able to show you. And something you probably haven't considered before, something that I know is going to change your life. It's already impacting my own family. So, here at Symmetry, we absolutely think that there is a better way, that we know that you can allocate your money, that you don't have to spend 74 cents of every dollar going to banks and the government. See, our debt-free life program is designed that we can be able to reduce the amount of money you're paying towards the interest and taxes and increase the amount of money that you actually have available for lifestyle purchases. You could save for the future. And that right there, that's designed to bring your debt down to zero. So I'm going to pause. How would it feel if you had the debt gone? Now, some of you are on here that said, I actually am one of the lucky ones. I don't have debt. Don't worry. I'm going to be speaking to you by the end of this too, because I want you to realize that you are in the best position to leverage your money. Everyone on here can learn better how to leverage their money and spend it more efficiently. So, in the debt free life program, you're going to be able to reduce your interest paid to lenders. You're going to eliminate all debt, 9 years or less for most. Sometimes we insert things that are on people's wish list. I inserted my daughter's car in college. So, we all have what do we want it to do, and that's how we design it for you. But no matter what, you're reducing taxes over time. You're improving your cash flow. So, therefore, you're saving more money. And when you do retire, this is the best part, it's tax free. So, by being able to do that, reallocating, what does that mean? So, experience has taught us that by utilizing a spending planner and tracking our money, that clients are going to be able to find inefficiently used dollars. All right. So when we take a look at that, we're going to help redirect them into a powerful impact on their future just by shifting when and how you use that money to pay what debt. And that's the magic behind what we do. So what it's gonna allow you to do, remember how I told you that Renee and Anthony, they're putting aside $25 a month because all of us want that 20% going into that emergency fund, the what ifs, the unexpected health situation or whatnot. Well, this plan actually already creates that 20% emergency for you at the same time of being able to increase and the other 80%, sorry, the other 80%. Oh, here we go. Maybe. Okay. Sorry about that. All right. So now the other side, if I were going to ask you right now, if you think taxes are going to stay the same, go down, go up, what do you think the future is for our taxes? Well, I just shared, obviously, we were already in $21 trillion in debt in our nation. It's going up big time right now. So they got to get it somewhere, right? So America as a whole having that debt, I mean, remember, they only have one bank to go to. You know who that bank is? It's us. It's us, the taxpayers. So if we're going to be the ones paying the taxes, and you know that that it's just no doubt taxes are probably going to keep increasing, right? So here's the thing that I like to address when people think about their 401k, because this is very relevant to the tax side of things, right? So let's say a friend or family member approaches you, which is the same concept here, like, okay, you're going to front all the money. I want you to take all the risk. You manage the business of this day to day. In 30 years, you're going to be required to pay back the sum of money that you owe. And we'll just say, for this sake, 25%, right? So, do you want to go in business with this person? Like, the reality is that the answer is no. But what do you think we are doing with every governmental traditional retirement account? This is the deal that we've been given. I'm going to put all my money in. I'm going to take what the market goes up, market goes down. I get to take the risk. When the market goes down, I lose money. How many of you have felt that impact the last quarter? For sure. So, yet I got to manage, where do I put my funds, and is there a better way to do this? And oh, I got to let it ride the market till it comes up. I'm going to manage what I do with it. But in 30 years, and it's time to come retire, Uncle Sam's going to say, hey, you can use your money, but every time you do, I want you to give me that 25% that you never paid before. That is deferred taxation. And that is exactly how an IRA at that, we'll say the 25% tax bracket, where exactly are the savings, right? So let me show you really, let's say we put $5,000 a year into our IRA, and that's going to, let's say we're earning 10%. That's what this chart is showing you here. So the rule of 72, so that's where you look, okay, 7 years later, I've now doubled my money. I got 10,000.
If I
Okay.
wasn't making
So, that being said, so now we got 5 to 10. If you look now, age 59, I've got 20,000, and age 66, time to retire, I got 40,000. Okay. So, how is that going to work if you said a tax deduction for how did I save, right? The tax savings, that tax deduction, you are right. All right. So now let me show you. So if we put the money into that IRA, we do get a tax deduction. Welcome to the right-hand side of that table. So in this case, at 45, you have your deduction, 1250. Then at 52, another deduction valued 2500, and so on. So by 66, you've saved $10,000 because of deferred taxes. And remember, you got $40,000. So if, when I ask you, what do you owe the government in taxes on the 40,000? And you said 10,000, you're right. But my question is, where did you even save anything on the taxes? You didn't. And remember the conversation I just had, our taxes going to go up? We're banking on the fact sitting here at a 25%. Just imagine that tax liability going up even more. So, is if my point is you can reduce your tax liability so you can put more money in your pocket, wouldn't that be something that would maybe make a little more sense for today? It's going to make the future a little bit better. So let's say we did use that $10,000 and hey, I didn't have to pay taxes. I'm going to invest it. Let's see what it would do. So if you took the same $10,000, invested over 28 years at 7%, working on that average tax rate of 25%, your account If you had it in a taxable investment, 41.9. A tax deferred, hey, I'll hold off taxes again for 49,866, and then in tax free, 66,448. Now, if you could pick one of these three ways, which one's standing out the most to you? I mean, it's obvious that there's different ways you can use your money into investments, but there's also different ways that your assets can be taxed. Taking advantage of them early on in life, that's a really good way to make sure your retirement's going to be what you want it to be when you do get there. So I'm not saying go and move all your money from your retirement account. That is not at all what I'm saying. But I am explaining that you can redirect some of what you're already contributing in these programs to be able to do it in a way to maximize your cash flow, yet minimize any risk. Okay? So remember Renee and Anthony, here's a snapshot of how we were able to help them. Okay, and remember they were going to have Anthony's plan, 30 years of taxes or 30 years of debt, right? And with his retirement strategy at 300 a month contributions at a 5% return, he had $408,000 ready to retire on. But since I already showed you what happens with that deferred taxes, you look at he really has $306,000. That's not a lot take home when you look at, remember Renee and Anthony both said they wanted to make $5,000 a month in retirement. So we've got about 5 years at that goal of 5,000 a month in retirement. They're going to be right back at work. How many times have you seen someone that's retired that they got to go back? They thought they had enough, but they didn't strategize enough. There is a way that we can actually change it. And this is what it changed when we were able to go through the Debt Free Life program with Renee and Anthony. We were able to get them out of debt in 7.8 years. Instead of close to $200,000 in interest they were going to pay, they only had 77,220 in interest. That saved them over $122,000 in interest alone. So remember I told you that that 2177 a month was going to be an important number? Well, that same amount that they were paying for bills before, now they were able to put it into savings for retirement. So when they continue to be able to do that, that means that if they continued using the program even for future bills or things that come up, they still are going to remain out of debt, and they were going to be able to accumulate over $1 million in their savings for retirement. And remember what I said, it's tax free. That is why you want to leverage life insurance. It is the only vehicle that you can take tax free without the risks. So that is definitely something that we like to teach people of utilizing it. When if you live, when if you die, it is a life insurance. It is designed to be there for you if you only know what you don't know. So if you remember their original retirement, right? They were savings, they were going down that path, $306,000 at the end of 30 years. So when looking at what would it cost if they didn't do this, because you got to put common sense on, it costs to not do it, not what does it cost to do it. I already told you we're going to talk about redirecting and not spending that extra money. But what would it cost if they didn't? It would have cost them $820,000, because that's the difference of what they would have lost out on, how much more they would have had to pay in just mere taxes and interest. There's a better way, y'all. So they're not the only ones that have been able to benefit from this. We have helped thousands of families so far, even in this last year. We've been able to help save over 17 million in interest for our families, over 115 million in increased retirement goals now. That's what's really neat when you hear what people's goals are and you can show them that it can happen. Over $53 million of debt that's eliminated. So that's pretty huge. And that's just been the last year since Symmetry has taken this on to make sure that we're going to impact this epidemic we have of debt. So Let's show you how it works because I think probably about now, people are probably like, yeah, I don't know. Is this just that debt consolidation thing? Is this what is this? Is this too good to be true? So we're going to go through exactly why and how does it work. So hopefully you got your questions. Before I go through the how, Michael, I know you're helping me man the chat. Are there any chat questions that I need to be taking a look at, or we're good so far? All right, so that's a thumbs up from you. We're good. All right. Y'all remember, you do have the chat feature. So if you have questions as you go, just make sure you put them in the chat. That way we can pause, make sure I don't go too fast for you. All right, so let's talk about how it works. There are three phases of our money. So if you look at these three phases, you got the maximization, accumulation, and distribution. Most people look solely at the accumulation. How much money do I have in that 401k? How much money have I saved up so far? But see, the reality is to be successful, you got to focus on all three of these because that's how we take our money. And whether or not it's taxable or tax free, it does make a huge difference moving forward. So in our debt free life program, we take all three phases into account. That is where financial success and financial freedom comes from. So now let me show you why this is something that, from a common sense approach, okay? Does anybody ever think about how the banks leverage cash flow, right? Well, let's think about it. So, as a customer, if we go and we put all of our money into the bank, and let's say maybe we're lucky you even have a 1% return, very rare these days, but let's say you're going to get a return off of it. So the bank then is going to take your money. So for every dollar you have, they're going to turn around and they're going to loan it out to other people. In fact, 7 more times for each dollar, because you ever notice it's just on paper that we actually get money from the bank. Hey, here's your loan document. It's valued at that $300,000 mortgage. So if they're loaning it out for every dollar that you put in, the bank's going to loan it out. And guess what? They're charging an interest, whether it's the car loan, the even, they're charging interest rates on any kind of money that they're loaning out. And in fact, if you even put $10,000 in the bank and you went in the next day and you wanted to go and take money out, you know what they're going to tell you? Well, this is your interest rate. Sure, if you invested it and you want to be able, hey, I'm going to use a mortgage. How many people right now are thinking about equity lines? Maybe you're taking an equity line. The reality is they're charging an interest on the money I've already given them, and it's hard enough to even get a hold of it. And how long do you have to wait to get it? And that's just one example of every dollar put in. 7 more times, there's more clients. The banks are leveraging and making money off of you, right? So every time with the different loaning that money out, that's earning them 136%, right? That's nice. Well, if they're earning that much, wouldn't you like to be the bank? What if you could? What if you could be your own bank through the Debt Free Life program by giving your dollar two jobs? The first one, we're saving. The second one, we're creating compounded interest for ourselves. Make your dollar work for you, not someone else. It's the same thing if you are, whether the credit cards. So many people, have gotten to a place that, hey, I put everything on a credit card and by the end of the month, I pay it off. Great. You gave them your money to still go and make money on other people. You forgot about an important factor. Make your money work for you. Where did you make any money in that proposition? What? Maybe hey, this credit card will give you 2% back. You could be doing better. And that's what we want to show you. So it's not like this is new for the world here. This is, these are empires that were created. It may be new to Symmetry to take this on as our personal endeavor to change the debt. But you know what? Infinite banking. If you ever Google it, maybe you've searched it. Do you realize that's where Walt Disney World, started with Walt Disney? You've got Pampered Chef. Ray Kroc with McDonald's, even Warren Buffett. So all of this, where the concept is, it's helped these heavy hitters in the financial world grow massive empires, and all because they utilize the power of compounded interest while having money available for their operations. See, like I said, the concept isn't new, it's just new to us. But the reason that none of us knew about it, nobody told it to us. Nobody actually broke it down systematically until now. And that's why you were invited here. We feel people need to know what they don't know. So that's what we're going to be able to do. So the Debt Free Life program is going to help you harness the power of life insurance. Do you realize by utilizing this, you're able to redirect inefficiently used dollars, allow the policy cash value to grow? You see, guaranteed, that's a pretty important word on there. These have a guaranteed 4% interest by contract. That means no matter what, your money's earning 4%. In addition, it's going to grow dividends. That's not bad when you're going to turn around and get stock market growth that they're going to give you back as dividends on top of 4% guarantee. So, what is that allowing you to do when you can borrow from your policy's cash value with no penalties? No, hey, you're not 59 and a half. You can access your money when you want, as you need. There's no tax on it. See, that's the beautiful thing about life insurance. We don't pay taxes. We don't pay taxes on loans. So when you take it as a loan, Boston Tea Party took care of that. There's no taxation on loans. Yet you're able to borrow from the insurance carrier's money, leaving your money still there to keep growing money. So meanwhile, while you're taking these loans, you're paying off your debts. And in most cases, 9 years or less. You're repaying your loans into the policy with the freed up cash flow. Do you know what happens when you pay yourself back? Oh, you get more money in the bucket, earning more guaranteed growth and dividends. You see where I'm going with this? You could have no debt paying a credit card off, but did you forget about the part you could pay yourself and then go pay the credit cards? That's the advantage. And yet, as this bank is growing, you're able to finance future purchases. Future things are going to come up, right? And that's where, as you grow this, it gets bigger and bigger. And guess where? You have even more access to cash. So the next time you need to buy a car, do you really want to take a loan off of someone that's going to charge you interest? Or do you want to turn around and take money from your own financial bank that you've created here? So that right there, remembering to be able to work off of the IRS code 7702, which says we can overfund our life insurance. Life insurance has to be given as a fair exchange in return. In this method, you're paying a very small amount for the insurance, and the bulk is all going into cash guaranteed growth. Together, that right there, should you pass away, now you've given your money tax-free to your beneficiaries. That's a legacy. Do you realize they don't escape the taxes when you give them that 401k when you die? There is a better way. There is a way that you can make more money while you're living and yet leave a bigger, better legacy. So, we've gone over all the benefits. What all can debt-free life do? At the end of the day, it is changing your life. It's changing what comes next, how you move forward of where you're paying. So I'm hoping that even just a little bit of what you've heard so far, it's made you jot down some questions of, can it do this for me? Does this count as a debt? What if I don't have, will it do this? That's exactly why we want to get with you on next steps. See, the reality is, when would you like to reduce your debt? I'm hoping most anybody wants to get out of debt right away, right? So then, of course, when would you like to improve how much money you have to spend or to save? I don't know. I'm thinking right now kind of ends up as the same answer, right? And how about, hey, when would you like to reduce your taxes? Well, same answer. So if all of these makes sense to you, then the reality is, what if we could put a plan together that's going to make sense for you? It fits your comfort zone, and yet it's going to put you in a better financial position. Wouldn't you be willing to make some changes just by redirecting where you're putting money and not spending any more than you're currently spending? I would hope that that would foster questions, because the questions get answered where we start on, let's look at your numbers. Your numbers are where this is really going to matter. I can show you many of my clients that I've been able to help. That's not going to mean a hill of beans to you. What does matter is if we get you these worksheets that you just simply you're filling out, what does life look like today? What are my financial goals? I told you that's where it started for Renee and Anthony. Well, that's where it starts for you too. Someone invited you to this meeting. If that's the case, whether you were texted, you found it on Facebook, you had a personal email sent to you, regardless, you were someone that's a connection that we know that we want to make a difference for you. Even as an agent, the best part is I was able to do this for my family too. And it does make a difference to see, even already, I've been helping clients even during COVID times. This month alone, been able to help them on, okay, so based on what's there, I'm supposed to pay off the car payment. Am I still allowed to do that? Absolutely. Let's get on the phone. They turned around and saw how easy. Take a loan out, pay a debt off, and now the 255 car payment, guess what? Pay it to yourself. Because when you're doing that, you're now snowballing that debt. You don't owe the car people anymore. But here's some of the other advantages is that if you miss a car payment, you ever notice you'll get a nasty gram. You miss two, you're going to go outside one day and that car's not going to be there. However, if you've paid them off and you're the one that you're paying, are you going to take your car away if you can't make that 255 payment that month? No, you just don't balloon your bank any further that month. So you don't even have to pay back the loans. You certainly don't have to keep it at the rate or the amount that you had before with the creditor. Maybe that in itself is how you can increase, what does cash flow, what does every month look like to you? And it all starts with going through, what are you spending? Where are your savings now? And how can you actually do better with what you're working with? So that is my introduction of Debt Free Life. And I promised y'all within this hour that we were going to be able to answer questions. I'm not going to unmute everybody at one time because that would probably be a little chaotic. But first of all, let's take a look in the chat. So yes, the question came up as far as savings for retirement. Were they now saving with the clients? He's referring to Renee and Anthony. Did they just shift where they were spending money into the savings? And the answer is yes. Same money. Never mind the fact life hopefully brings you raises and, hey, we come into windfalls of money. There are other ways that you can actually add extra when you want, because it's all about the more you put in, the more you get out. So that one answers there. Um, how much does this cost? There is no set cost. That's the whole point. That it's not a cost. You're not buying anything. You're actually going to create, based on your current spending, what is the appropriate bank size for you. And that's where we utilize the software and the skill sets of how do we create that. Let's see. Okay. Um, how does the death benefit work? So it works exactly like a life insurance, because it is a life insurance. So if you should pass, your as you so what happens with the and I wish I had a really good slide to visualize this for you, is the fact that what happens, actually I do. So I'm gonna talk it through, and then I'm going to share with you one of the other, and this is actually courtesy of Scott Forehand that I know is in here, um, that there is a way you can, your money is going into a minimum base amount. That is your whole life policy and term life, that you have that stack to allow this other bucket of putting your money into. right? So if you have the whole life, the term life, and a cash value bucket, every dollar in there goes to cash value. Imagine it's kind of like when you have the principal in your mortgage, right? So by having that, that is exactly the paid up additions where you earn dividends. That is where you're actually receiving money on all money you've paid in addition to the 4%. So the common question is, whatever I've paid in, are my heirs going to get that? The answer is yes, because as you get paid up additions, the death benefit is worth way more than what you've ever put into it. That is how life insurance works, right? Is that you have a set premium and yet it's going to grow to be able to give you a higher death benefit. And that's exactly what the whole IRS code is built on, that we can overfund, but you have to have a fair exchange of death benefit in return. And it's the death benefit you're leveraging for the loans. What let's see, that's for the chat. I do want to be able to put up this other share screen because I think this is really cool what Scott provided, if I can get it to work for me. In the meantime, y'all, you do have the little microphone on your own, whether you're on an iPhone, a computer. What questions do you have? Let me see what we might have from the gallery while I figure out getting the screen share. Any questions? Did I do that good a job explaining, or are y'all just a little shy to ask? You can type them in the chat if you'd rather. Okay, if you don't pay, okay, so a question has come in, what happens if you don't pay the loans back? So this is exactly where I think this visually will help. All right, so all right, so I will get to what's on the screen here in just a moment. So you do not have to pay you do not have to pay the loan back. Here's the concept, is that you're getting a 4% guaranteed annual, you're getting growth, right? And it's actually based on every month you've put money in. So you're borrowing from the life insurance company themselves, their general fund, right? So actually, I am going to share because I think you can see even with this. Um, and Scott, I know you're on here. I thought this was the one that was going to show even where the life insurance buckets are. So at the end of the day, you do have 4% and you get dividend interest growth. So if you have the average dividends over the last 20-year look back has ranged from 7 to 11%. So let's just call it 6% even. Let's be very conservative. So if we got 6% along with your 4%, that's an average of 10% that you're going to get added back. If you didn't pay the loan, you're getting that credited back to your cash value, and it's going to offset where you have a loan outstanding. It starts to reduce it. If you should die, let's say, okay, I took the massive loan out, paid the last $120,000 off on my house, and then I passed away before I paid it back, it's simply deducted from the death benefit. But if your death benefit's sitting at $400,000 and you have that 120,000 house already paid off, you see where you've still left the legacy. You just took the money while you were living instead of while you were deceased. You still have a heck of a lot because you're always going to have more. You can never borrow too much. They only allow you to take 95% of what you've put in. Now, here's the thing. When you put your money in, it's compounded interest. Okay? So this is I'm going to go to the next one. Here it is. I knew it was there. You can see, maybe. Aha. Watch. Okay. Thank you, Scott, forehand. Okay. So if you look, you got your whole life. and you've got term life I talked about. And then you have a third bucket of paid up additions. Okay. So that being said, all of that is what's culminating the death benefit itself, but it's also culminating where are you going to be earning money. If you paid whatever your premium is every month, you have a small amount going into the whole and even really tiny amount into the term life together, that's your required monthly minimum. Anything you overfund is going into this paid up addition. Now here's the best part is that remember I had said that this automatically helps you create the 20%. Over here, you've got your term and your whole life that this section over here is still going to earn 20%. That's going to be earning your 4% guaranteed interest. Well, that right there is culminating that emergency fund that I talked about. Okay. So now if you're paid up additions every month, the biggest chunk of what you're paying is going right over here. This paid up addition is where you actually have your 4%. So if you made a payment in where are we in May? You made a payment in May. They are actually doing 1/12 of your annual 4%. So every month you're getting a 12th added to it. Every month you're making a payment and that compounds. See, we've all gotten up against the credit cards with compounded interest on the bad side, right? Of whatever you haven't paid, now you've got an extra interest fee of what you haven't paid off. This is the opposite. This is what you've put in. You've earned 1/12 of your 4% guaranteed. Not a bad deal when that compounds over time. And then at the end of the year, you have your annual, hey, here's your dividends that the insurance carriers paid to all of their members. So, that being said, the death benefit is rising as you're putting in to the paid up additions is one way that you're getting those dividends, as you're inflating that cash bucket, you're getting a fair exchange of death benefit in return. So that side of it is getting bigger and bigger. So that's why if you had a loan outstanding, it's going to get paid off anyway if you should pass away. Maybe you don't even want to pay the loan back. Okay, let the dividends and the interest carry it. Just remember, I'm going to use the car payment that I talked about. I helped Heather with, just last month. It is the fact that that 255, you have a choice. You don't have to pay the loan back, but if you do, you're actually increasing the availability now of going back and borrowing again, even before the loan's paid back. You can take multiple loans. So I like what's up here. I'm going to go back one of what the current method, and this is definitely talking to people that are putting money, like they're charging all their bills on their credit card. At the end of the month, they pay it off. They have no interest. And I told you, look, you're kind of missing one of the best parts of what you can do out of this. It's called infinite banking. If you don't have debt, create the infinite bank. Give your money a little pit stop. So if you take a look, and you have your money coming in, right? And most of the time people are turning around and they're paying their money right on over to their debt. So we got the income and we got the debt. But what if when you whoops, what if when you had your money coming in that you turned around and you put it into your current DFL bank? It's going to cycle through there and through your whole life, your term life, your paid up additions, right? When you go to take a loan, you're actually doing it from the carrier right here. Remember I said the general fund. You're going to take the money out from the carrier and go and pay your debt. So meanwhile, your money's still sitting up here cycling and earning. So if you take a look at two strategies, one, putting it into the bank, not earning you squat, charging you interest if you want to be able to borrow equity off that house or whatnot, but you turn around, it's not growing anything here, you're going to use your same money to go pay debt. So the top line is showing just give it a pit stop. So the good results out of that is that your money is going to work for you until you pass. All your debt's going to get paid off 15 to 27 years early. That's right. Some people have been able to get out of debt in just 3 years. It's crazy. You're going to have a safe growth vehicle for your money in this place of it, right? Um, you never have losses. You get to participate with the market and yet ignore market losses, right? So there's no IRS telling you how old you have to be, what amount you can take out, you got to pay taxes back, none of that. You're going to be, it's tort proof. I think this is definitely good that, you know, it's a contract not governed by the IRS or banking law. That's a pretty big one, especially if you're a business owner. Guaranteed growth in it, dividends growing, paying off the carrier loans for you, or you can turn around and pay loans automatically. There's so many good things about it, right? So the bad thing is that the IRS gets to take less from you. Well, that's bad for the IRS, not you. And the bank, they don't get to make as much money with your money. Oh, that's bad for the bank again. So I don't know. There's been no downside, and I saw a couple questions popping up that I think actually that's the perfect place to be able to answer it. Of you know, what if, let's see, how long do you have to be paying in before you can borrow? It's all in what you put in it. You can put your money in, and like I'll use my client that we paid the car payment off last month. They got their tax return back. We dropped it in. 2 days later, the money showed on the account. You turn around, she took the loan. It was wired to her account within 3 days. I'll say 5 to play it safe. She got it in 3. It was in her account. She turned around, she paid the car payment off. So you can have your money access to you. You put those days together within 5 to 7 days, right? Drop your money in, take your money out, go cycle it. That's what this cycled screen is showing for you right there. Um, so what happens if you, oh, this is a really good question. This is going to be one that's going to be more specific once you get your actual plan put together. But in a normal whole life policy, you're paying a large chunk on all whole life. And I told y'all a small amount's going to go to the whole life, a smaller amount going to the term of your payment every month. That part is required. Here's the best part. The paid up additions, you actually don't even have to pay. Let's say you have a particular month and it's tight, as long as, and it depends on the carrier for their rules. However, you have a really tiny minimum. I'll use Mutual Trust, one of our carriers. $100 for the year is all they expect that you're going to pay it in the paid up edition. That's it. That's $8.34 a month, or $100 if you've already put one payment in and it covered it. You can say don't take any more for the paid up editions. Things are tough right now. But remember, as soon as you can, turn it back on, because the paid up additions are your forced savings that are growing you. Okay. So I had quite a few. What if I can't pay? What, or how can you fluctuate it? How flexible is this? I'm getting some private chats that are coming in too, and they're all pinging each other. So when you borrow, I've already explained that you're borrowing from the life insurance carrier. When you take a loan, you're not taking out of your cash value. In fact, that's what makes this work so well. Your cash is still sitting there earning interest. Okay. So if where, all right, in Heather's case, it's just helpful to use a live example. Heather dropped in $5,000 from the tax return. She already had a little money in there. She took $5,600 out, right? Took $5,600 out. You know what's still showing in her bank? $5,600 earning that 1/12 of 4% interest. She pays off the car, and now she's going to turn around $255, going right back to paying the loan. It now, she's paying the loan off because she's actually wanting to increase how fast she has access to cash. She didn't have to do that. She could add it straight into the paid up edition. You have a choice. That is where we're the professionals to work with each scenario, because I could get in the weeds going through that. Let's see if there are other questions. Anybody think of any while I'm scrolling through the chat? The question is, do you have a chart with policy amounts and premiums? Once again, that is always going to be based upon your own plan that's put together, right? Because it's all going to be based on your age, your health, and all of that. Hopefully that helps. So your next step, get with the person that invited you. Let us help you find out what is your answer. How much is it? I can tell you it is a much more affordable, cheaper form than your traditional whole life. Selves, if you If you could stay muted unless you have a question, then unmute yourself. That way we don't accidentally unmute all the lines. Anybody have any verbal questions?
Hey, Dana, this is Mike. I think you might have already answered this, but is there a cap? Is there a limit, top limit to it, or ceiling?
So this is designed based on one, what does life look like today? And two, where do you see your future of, hey, I may not be able to afford too much extra now, but down the road, I do think I will. That is the purpose of that term. All of this is based on IRS code 7702. That right there is what's going to, for lack of a better word, I want you to imagine this is a life insurance married to a Roth. Remember, Roth is tax-free. Roth gets to grow money on the market. The difference is this is an insured Roth that you never have downside. So you get the indexed crediting, the indexed gains, and never any losses. So when it comes to caps, the only cap is how much overfunding you're allowed to do before it could become what's called a modified endowed contract, which would actually turn it to be taxable. Can I tell you that the insurance carrier doesn't want to see you do that unless it's really intended? Some people do that for estate purposes, but rare, ever said rare. All right. The reality is that you are you're following guidelines. So, all right, John and I are in a position that I think to use as an example that we know that with some of our tax, well, the PPP stuff, like we have a max amount we can drop in our bank. So we're only dropping part of it so we don't met. And then come October, we can drop more part of it. So you can manipulate. You'll never get sucker punched by it, but it's amazing how much the more you put in and it grows, you actually increase your amount that you're allowed to put in. So there are caps because of IRS guidelines, but that's what we're here to help you do. Any other questions that you're seeing in there that I'm missing? Because there were a lot of them posted there, Mike.
Just the other one. How long does it take to get a plan in place, and is a medical exam required?
So one depends on your age and which carrier. Most do require an exam. And this is where we kind of pivot a little bit of our thinking. I want you getting the lowest cost of insurance, right? Remember that small little bucket? We want the cost to be really low. So I do encourage the medical exam. Now and even during COVID, we have nurses that are doing medical exams. All right. There are some that when they look at it, hey, you're young enough, you're not going with too big of a bank, we can go ahead and approve you without requiring that. But I would say go ahead and do that. I think that was only part of the question, though, Mike. What was the other side of that? The medical exam and,
How long does it take to get a plan in place?
oh, so first part, fill out your worksheets. We can get back to you, I would say, especially as busy as it's been. I would say definitely give us 3, 4 days. And what we do, we'll utilize the software. We'll work with the design team to create, this is what your plan looks like. And you're going to see, just like I showed you with Renee and Anthony, how long, how fast can you pay your debts and when can you start it? That's part one. That can take a few days. We can get together on Zoom. We literally can get together on Zoom. That's an advantage, just like you're here right now, right? So I would say plan on by next week. We get on Zoom, we show the plan to you, you see if there's any tweaks, we apply for the plan on your behalf. That's exactly what we do. We're your liaison to the carrier. We apply for your insurance. Some cases have been getting approved within a week or two, and some have been taking longer. Sometimes they need to order your doctor's records. It really depends on the carrier. I would say sometimes it really can take 4 to 6 weeks. Um, on a really good day, really small bank, I had one approved in 3 weeks. So if that answers how long, how fast, it's not an overnight thing, but it is definitely worthwhile.
I think one last question. How long do you have to be paying in before you can borrow out of the account?
You could, the very first month, literally 2 days after you put your money in, you have cash value in it. So even if it's I got $200, I'm going to put $200 in, you're allowed 95% of that. So, okay, here's your 100, whatever 95% of that. We'll say if I dropped $100 in, I had $95 extra. All right, I'm going to take $95 out. 2 days later. So what happens when we do this software planning for you folks is that we actually strategize what are the best debts to pay when. It is not where it's just, oh, I'm going to pay the highest interest rate first. Surprisingly, the software comes back with what will get you paying off all the debt the fastest. So that's what's really cool about this is that we really can show you to the month based on the insurance plan that we put in effect for you because we know from guaranteed contract how that plan's going to grow. What else? Is there a ceiling? That's the opposite of cap, but I do want to address it. This thing never has a ceiling how big it can grow. Infinite banking. You got the debts out of the way. Great. Keep growing it because that's where it's an infinite bank. So there's no ceiling to the growth, and there is very large, especially if we plan for you're going to have increased input. There's a large amount before the cap hits you of how much you can put in. And here's the best part. You can turn around and do another bank if it gets too big. Just create another bank. Start up a second policy. You can have as many of these as you need. So now, no, you don't have a cap, and there's still no ceiling. I have a private chat. What if you're okay? This is insurance. What if you can't necessarily, you don't feel you could get covered for insurance? I would love to address this because several of my families have been able to help. Whether it's you're with a husband and a wife, and one is healthier than the other. Hey, they're both healthy, but one's younger. And let's face it, us women, we get a lower cost of insurance. So we look at common sense sometimes. But here's some other unique strategies. You got a parent and they co-signed on their adult kid student loans. They know if something happens to that kid, that student loan goes to them. Did you know that's a debt you actually cannot write off? It doesn't go away with you in death. It will roll to your estate and it's going to hit your parents. So all that being said, they have insurability rights that they turn around. Their adult child says, I'll go ahead and let you create a bank on me, but yet they've got insurance on them. So if my adult daughter has $200,000 in student loans and I have a $300,000 bank, if she should pass away before me, now I can pay off those student loans anyway. The whole goal is more so on the mom and dad are over here creating their debt-free life. They're, hey, we're going to pay off the home that our daughter's going to get. Hey, we're going to work towards paying off these credit cards, the car payment. We'll come around to your student loan when we get there. You can put that in there, but we're paying off our debts and cycling this. When they're done paying off, mom and dad are done paying off, they can continue to pay in and address those student loans. The daughter who's now working and the student loans are hitting, she's paying those, or if she can, now she can use the bank, take over. They can cash it out. Hey, thank you for the bank. I'm taking my money and running. That was one of the other questions. Is there a penalty if you choose to cancel the bank? No, you're there. It's not, you don't have the surrender costs, right? You have your cost of insurance, that's deducted from what you paid in. So that's where you're going to have all of your paid up additions you paid in. Yes, you get to keep that. That's your money. There's no surrender fee on that. Um, let's see. I'm going down, I'm trying to run down the questions real quick. Mike, you see any others that I haven't addressed?
No, you got them all in the chat.
Okay. All right. Any other questions verbally? Okay. So here is what is next. Awesome. Okay. Um, you got to start somewhere. So now you at least know what debt-free life is, right? Do you know how long before you'll be out of debt? Do you know if this will work for you? No, you don't. You know how you can know? You're going to get a follow-up email. One, I'm recording this. So yes, I'm going to send the recording in case you want to watch back. Maybe you want to share it with someone. I'm okay with that. um, but you were invited here by someone else too, either myself or one of our agents that are here, and they invited you. I want you to reply back. What are your thoughts? What was a takeaway? Even if you don't even want to move forward, did you at least have a takeaway from this that might help you? Because that's the biggest part when we're educators. That's the biggest part we get out of this. But hopefully your response is, I'd like to know more. Okay, so if you were invited, we're going to send you the worksheets. You fill it out, let us jump on, you schedule, you coordinate calendars. We're all extremely busy right now, but that's exactly where we want to make the time with you. So let's coordinate a calendar. We're going to schedule you in. So if you know, come 1 o'clock on Monday, we're going to be on Zoom together, I'm going to have some answers, but only if I get the worksheets back from you. So that's where you start. I think it's definitely worth your time. There's zero commitment. We don't charge for anything we do anyway. I just really know that we can impact this debt epidemic that we got. And it's just going to take word of mouth. It's going to take you telling 10 other people what you got to hear tonight. It's going to take you inquiring more questions. But I know that there's a mass amount of us that we went through the certification so we could do this for you. And we're excited to do so. So with that, if there are no other questions, I am going to go ahead and let you guys go. I look forward to use this time. Ping the person that invited you. So y'all have a great night.
Great job, Dana.
Thank you, Mrs. Els.
Thank you all.